Hi buddies, how are you doing? So let's wind up with those final provisions, whatever we're doing, my dear friends. So let's come to MAT. If you remember, we're doing minimum alternate tax. So we did all the adjustments, if you remember. So many things we did. It was easy only, right? And we finished almost everything in MAT. Cool. So let's, if you remember this chart, when this page number S2, we saw what all will be added, what all will be subtracted, everything we did. You can go through that video again to understand. Very, very simple. So today we'll do finish off MAT, then we'll do one chiller concept called AMT and two chiller things which we have already done, amalgamation and demerger at various junctures we have done. We have done amalgamation and demerger in PGBP, we have done it in capital gains, and we have done it in a little bit of other things. So little bit of set off and carry forward of that also we will do. Basically it's the revision of whatever we have done till now. So that we will finish it off, demerge and amalgamation. Then small concepts will remain, guys. Of course, set off and carry forward a separate chapter we need to do. So all those we will do and wind up. As I told you before international taxation, we told that majority of the portions, all the important portions are covered. This is all like, miscellaneous items. Since it's there in the syllabus, we have to do, and questions may come also. You never know that questions will not come. Of course, in MAT, questions will regularly come. AMT, it will come. So everything is important. We will not, miss out anything. But what I'm trying to tell is the level of depth that, generally we used to do is not needed here, because this much depth is good enough. Otherwise, it will get too burdensome for you guys itself. Okay. So, sorry. What happened to this? Let me close this down. Good. So essentially this is what we had. We had done all these provisions. Business trust and all we had done. So let me close that area. Right. So apart from these classes, let me see if I can record 10-15 hours more of Q&A. I'll try to do that. I'll try, guys. I'm not promising. I'll try my best. I'll either put it up on YouTube or I'll give it to your access here only. So keep a keen lookout on my YouTube channel for all these areas. Okay. So MAT we had done, guys. So if you remember, we had done all these things in the previous session. Let's come to this. Special provisions for Ind AS compliant companies. Ind AS compliant companies. So basically they are trying to tell that for Ind AS compliant companies, there is something called as, for computing book profit, just a sec. So this is the lecture 88, we'll finish off everything. For computing book profit, right? The net profit shall be taken. This is for Ind AS compliant companies. For computing book profit, net profit shall be taken. Net profit shall be taken before considering other comprehensive income, OCI, other comprehensive income. So in Ind AS, you will find this concept called other comprehensive income. So here what I should do, I should compute the net profit before this computation of OCI. And once I compute OCI, there are some adjustments that I have to do. That is what there is to it here. Check it out. The book profit shall be computed considering the following additional adjustments. Items, these things should be added, these things should be subtracted. First one, items credited to other comprehensive income and not reclassified to P&L account. So guys, as per Ind AS, those items that you shift to what? something called as OCI, other comprehensive income. You guys will know, in accounting, FR, you will know when this index is done by your faculty, you will know that what all incomes will go to the other comprehensive income. So those incomes credited there to other items, rather credited to the other comprehensive income, not income credited, items credited there. If it is not reclassified into P&L account, in that be the case, then what should I do? I should add it here to clean the P&L account. So it should be in sync with Ind AS. That's what this particular thing says. So if you see, following items shall not be increased or decreased from the book profits. That is first one. Now, these two are important, guys. Revaluation surplus from asset in accordance with AS 16 or AS 38. This asset would be your property, plant and equipment. Property, plant, equipment. So generally, guys, when you shift all the assets, etc., you will obviously take the FMV. You'll obviously take the FMV. So here, what they are trying to tell is, for instance, what they are trying to tell is, this is one part of the story. Second part is intangibles. Intangibles under Ind AS 109. So equity instruments, intangibles plus PP, property, plant, equipment. So basically, if the book profit is 100 lakh, I'll write here. Book profit is 100 lakh. The fair market value is 300 lakh. As per Ind AS, you should record it fair market value, right? So basically, this 200 lakh will be called as other comprehensive income. Ideally speaking, this is not adjusted. That's why it says add items which are not to be taken here. You see, general rule here. Items credited to other comprehensive income and not reclassified to P&L account. So from the book profit, you add those items. So basically, what you are trying to tell is aligning yourself to the Ind AS, you will have to increase your book profit by these items, because as per Ind AS, you should take that into consideration. If it is, as I told you, property, plant, equipment, and equity instruments, that is, I will consider as an intangible. In these cases, my dear friends, book profit is 100 lakh, FMB of that is 300 lakh. This 200 lakh should not be adjusted. Right? Mind you, it clearly says here equity instruments, which means debt instruments to be adjusted. Only equity, which means this exception not applicable to debt instruments. Not applicable to debt instruments. Not applicable to debt instruments. Okay. Which means this OCI should be added if it's a debt instrument. But when an equity instrument, it's not to be added. Why, guys? Because it doesn't mean it will never be added. What they're trying to tell is, tomorrow, if I sell this entire share for, let's say, 360 rupees. So what is the book profit? 100. What am I selling it for? 360. So 360 minus 100. That is 260. This will be added later. So just remember, guys, items which are credited to, P&L account, credited to comprehensive account, OCI, other comprehensive income account, but it is not reclassified to P&L account, I have to add back. For example, if I sell a debt instrument, book value 100, but FMV, I'm bringing it into the book, so FMV is 300. That extra 200 I need to add back. However, just note that for these three items. Asset, property, plant, equipment, intangibles, equity only, not debt. If there is any variation, this 200 will not be adjusted now. It will be adjusted later. 360 minus 100, 260 will be adjusted later. Did you get it? Cool. So that's what they are trying to tell. Next, gains from changes in the fair value of equity instruments already discussed through OCI and revaluation of surplus from assets, retirement, transfer. But as I told you here, on the above items, what above items? PPE, that is PPE, property, plant, equipment. It will be done only when the asset or investment is retired, disposed, realized or transferred. All other assets, you have to make the adjustment here. All other assets, you have to make the adjustments here. Gain, whether it be a gain, whether it is, the fair value adjustment, right? They'll only give in the exam that it will be added to the other comprehensive income like that, right? So then you should reclassify it. But other items like these things, plant, property, equipment, etc., should not be taken into account. It should be taken into account later. Amount debited to P&L account on distribution of non-cash assets to shareholders in a demerger as per Appendix A in Ind-AS 10. So if you see, any amount debited to P&L account on distribution of non-cash assets. So guys, on demerger, for example, if there is a company ABB, this was the first ever demerger in our country, it became ABB Power. So as we have already seen in demerger and capital gain, etc., the assets of this will be shifted to this. The period of holding will come from here, cost of acquisition will come from here, everything will come from here. So this transfer, when it is shifted, is not a transfer we had seen, right? So it is generally exempt. So basically, if, for instance, if I have transferred assets worth 50 lakh, but the fair market value is coming up to 75 lakh, that extra 25 lakh will be exempt. But here, my dear friends, I need to add it. Amount debited to P&L account on distribution of non-cash assets to shareholders in a demerger as per Appendix A. That I have to add. So if you see note number 2, in a demerger, in a case of resulting company where the property and liabilities of undertaking received by it are recorded at values different from values appearing in the books of accounts, immediately before the demerger, any change in the value shall be ignored for the purpose of computation of book profits of the resulting company. So, though on top they say, right, here, what did they say? Book value 100 lakhs, FMV 88 lakhs, right? So, what will I do with that 12 lakh? What will I do with that 12 lakh? So that 12 lakh, my dear friends, it is an amount debited to P&L account that has to be added back. It has to be added back. On the other hand, reverse case. Are you understanding this? Amount debited to P&L account on distribution of non-cash assets to shareholders in demerger. Book value is 100, FMV is 88. So that 12 lakhs will be recorded in the book profit, which is a loss. But now I have to add it back because that effect has to be neutralized. Basically, effect of demerger has to be neutralized as per the lawmaker. Makes sense also because that will give me my final book profit. On the other hand, it was reverse case. So the company which is getting demerged is called demerged company, that is ABB. ABB Power will be called as resulting company. So the book value is, let's say, 100 and the resulting company is, let's say, 250 lakhs. This 150 lakhs is the gain. This gain 150 lakhs is reduced from where? It is reduced from the net profit of demerged company or resulting company. Obviously, it is reduced from the demerged company. Correct? We'll see further about that. Check it out here. In a demerger, in a case of resulting company where the property and liabilities of the undertaking received by it are recorded at values different from the values appearing in the books of accounts immediately before the demerger, any change in the value shall be ignored for the purpose of computation. So if anything which is valued at 100 is being shifted at 120, that 20 will be ignored is what they are trying to tell. On the other hand, if there is a loss, reverse case, book value is 100, fair market value is 80, that 20 will be added back as per this. It will be added back as per that. Apart from that, as far as demerger is concerned, all this we saw. Additional point also we saw. Now this example, as I told you, this 100 lakh, 250 lakh, this 150 lakh. This gain will be reduced from where? So if you see here, shall be ignored for the purposes of the resulting company. Book profits of the resulting company means what, guys? This 150 will be subtracted from demerged company. Now tomorrow depreciation on the asset will be taken on 250 or 100. Because this 150 has been ignored, depreciation will be computed on 100. Depreciation will be computed on 100 and not 250. Hope you got the point. So guys, if the book value is 100, FMV is 88, this 12 will be added back as per this point. On the other hand, if the book value is 100, selling at 150, the 150 is ignored in the resulting company. Which means this will be adjusted with the demerged company. 150 will be subtracted from there. Very simple. And the depreciation will be on this 100 and not 250. That's what they're trying to tell. Very, very simple. So write down 2 points to explain this transition effect here. Guys, 1, 2, same point is you have to subtract if there is a loss. Here it's item credited to other comprehensive account, here item debited to other comprehensive account. And here it is gain, it is loss, it's the same. But what is this 1/4 of transition amount, we'll see. That is what we have to discuss. So write down, when company adopts Ind AS for the first time, let's write down, when company adopts Ind AS for the first time, comma, the transition difference is transferred into a separate account in the balance sheet. The transition difference is transferred to a separate account in the balance sheet within bracket for the first year. Full stop. Only for the first year of convergence this happens. This amount shall be added or reduced. This amount shall be added or reduced from the book profit. Across 5 years. Across 5 years. That is 1/5 every year. 1/5 every year. Next point. From the transition amount, any foreign exchange fluctuation, on account of revaluation of PPE, that is, we have discussed what PPE is, or revaluation of equity instruments, shall be excluded if they are included in the transition amount. Why? Because that is separately done only at the time of sale. Here, the same thing I have given here. See, transition amount adjusted in other equity, excluding capital reserve and security premium account on convergence date, but not including the following. This one. Ind AS 16 and 38, equity instrument, all that you have to adjust. Property, plant, equipment, investment in subsidiaries, and all these things. So basically, guys, in this particular case, what I should do, 1/5 of the transition amount I should add, and 1/5 of the transition amount I should subtract accordingly, depending on whether it is a profit or a loss. Then apart from that, it's the same. This is in compliance with Ind AS, then the tax surcharge, then it remains the same. Apart from that, other points are already discussed, including the MAT credit. This one we had already done in international taxation. Kindly recall. If there is an increase in the book profit due to advance pricing agreement or secondary adjustment, Section 154 rectification should be done. We had seen this already. Refer international taxation discussion. See here. What all I should subtract from here, guys? Transition amount means adjusted in other equity excluding capital reserve and security premium account on convergence date. But it will not include the following. One is amounts adjusted in other comprehensive income, revaluation surplus under Ind AS 38, equity instruments, property, plant, equipment, and other intangibles, all these things. Once you do a sum, you will understand. They had given it in May 2018, if I am not wrong. Come to the compiler, R7. Compiler, R7. Alpha and Beta Tires Limited, Indian company engaged in the manufacture of tires in Andhra Pradesh, had adopted Ind AS from 1/4/2017. The following particulars are provided for the year ended 31/3/2023. Net profit as per statement of P&L account is 20 crore after debit and credit of the following items. Items debited, depreciation 18 crore. Included in depreciation is 3 crore being amount provided on revalued assets. Will you take that? No. Interest charged for delay in remittance of tax related source 20 lakhs. Should you take interest? Is it part of the amount of tax payable? What do you think? Share of income from AOP 50 lakhs. AOP is charged at MMR. Amount of 6 crores withdrawn from revaluation on account of revaluation of asset. Application of a financial creditor for CIRP has begun, admitted in the Hyderabad bench. Guys, if that be the case, what had we seen in the previous class? Business loss and depreciation, whichever is less, generally you should take. But when this NCLT thing comes, I should add everything and take. See here, this is that part which we did now, Ind AS part. Items credited to other comprehensive income will not be reclassified to P&L account. Remeasurement of defined employee retirement benefit 50 lakhs. Revaluation surplus of property, plant, equipment 1 crore. Transition amount as on convergence was 5 crore including 50 lakh. Should I take that 50 lakh? No. You see, net profit as per P&L account 20. Here 20 crore. And I should add the full depreciation first, 18. Interest in delay of TDS, yes, that is part of, very much part of the, tax payable, that add less what? Share of profit from AOP. We gave you the logic. For partnership firm, they reduce, but what about AOP? Have to reduce. Amount of depreciation debited in statement of P&L account, excluding the depreciation on revaluation of assets. So it is clearly they had mentioned here. $18 crore, 3 crore was revalued asset. So I have to subtract 15 crore. Then revaluation also have to subtract 3 crore. Accumulated loss, add everything. 3 plus 5 plus 1 plus 2. Otherwise, I should have added this 8 or 3, whichever is lesser. Then I should have taken 3. Now it is what? 3 plus 5 plus 1 plus 2, because it has gone through IBC. So here 11 I will subtract. Book profit before Ind AS adjustment. Items credited to OCI. As I told you here, all items credited to OCI and not be reclassified to P&L account. Since it cannot be reclassified, to align it, I have to add back. So 50 lakhs I will add. Next, guys, I told you, what about the second one? Revaluation surplus of property, plant, equipment, 1 crore should not be taken now. It should be taken at the time of disposal. Not to be taken now, ignore. Transition amount of conversions, 5 crores. 5 crores minus 50 lakhs, 4.5. 4.5, 1/5. 1/5 of 4.5, that is 90 lakhs here. Then MAT, surcharge, all these things. MAT, this ultimately, this will come. Tax payable is 1.77. Normal 15% of MAT this month. Normal provision, this one. Ultimately, MAT credit. Very simple. See guys, 6 marks question, easy. So I hope you are able to understand MAT. When MAT is for individuals, MAT is for companies who have opted for 115 BAA, BAB. If they opted for that, MAT will not apply. For others, those who have not opted for 115 BAA, BAB, what will come? AMT. For companies, I repeat again, scratch everything, I will coolly repeat, MAT will apply for companies. Second, if companies have opted for 115 BAA and 115 BAB, where lesser taxation was given, MAT will not apply. So none of the MAT provisions will apply there. You cannot take MAT credit, nothing. On the other hand, for other than companies, that is for individuals, AOP, etc., we have AMT, alternate minimum tax. Very, very easy it is, AMT. Alternate minimum tax, AMT. Applicability, computation of amount. So guys, AMT is very simple. This is for other than companies. If you have opted for 115 BAC, the new regime, then AMT provisions will not apply. Same like companies only. For companies it is BAA, BAB. Here it is BAC. So here the problem is, I have looted money from the companies through MAT. Government is telling I will take extra. Basically, whatever you deserve, because you are earning, because of various deductions, etc., you are making the income less, I will take a minimum alternate tax of whatever, 15%. On the other hand here, I will make the adjusted income. So I will add, here government realized that you will be taking 80 IA to 80 RRB. These things, if you take, I'll have to, probably your income will be so less that you don't have to pay tax. I'm not agreeable to this. I have to charge you something. So, but if you do for cooperative societies, ATP, that you exclude, except ATP, other things, I will add. Then if you have taken any deduction under 10 AA, I'm sorry, I will add that also. Third one, if you have taken any deduction under scientific research, that also I will add. But if you have not taken scientific research 35 AD, but you have taken depreciation and additional depreciation, that I will subtract. So this will be my adjusted total income. That's it. That is AMT. So they are only concerned about these things. 80IA to 80RRB, 10AA, 3580. If you have considered 3580, this. If you have not considered 3580, then this. Depreciation and additional depreciation will come. This adjusted total income, if it is, if your tax on normal provisions or 18.5% of adjusted total income, whichever is higher. And if you pay as per AMT provisions, you will get AMT credit. Just like MAT credit, you will get AMT credit. Very simple. Right? So tax. And here it is ATI. On the other hand, if the adjusted total income is 20 lakhs, less than 20 lakhs, then they'll be like, leave it. AMT will not apply. We'll see everything. This is the gist of the story. That's all. Let's check. One second, guys. Cool. Check it out. Page T.1. Page T.1. Sorry, guys. Yesterday I couldn't sleep only. So today, little, eyes are closing off. But don't worry, right? That happens to all of us are human beings. For me, no, people ask me, sir, do you edit your videos and all that? I said, I want to be raw. As you see me, that's how I am. I don't want to edit, add masala and all those things. Generally, I don't have an editor also. Actually, now I have to buy because I need to cut videos and post it on YouTube. Generally, I record and post the entire thing. So many people ask me that, do you have any editor? Which editor do you recommend? When I say no, they'll feel baffled. They're like, this fellow is lying. I genuinely don't have. Now I have to purchase one editor in the sense editing software, because I don't edit. So people will be like, when I talk to students, other faculty members, when I talk to students, I'll cut that. Sometimes, sir, I yawn in class, I cut that. For me, nothing. It is raw. What you see is what you get. It should be like that, no, guys. So because of yesterday not getting any sleep, I'm feeling little sleepy. Mind is very alert, but feeling sleepy. So I yawn. No problem. But people know they edit this video. I don't want to. First of all, time waste. Second is, we are all human beings. Come on. You also, how many times I can see from here, how many times I've slept when I'm taking class. Morning you'll be seeing, and slowly you'll be like this, correct? All happens. Okay? All in the game. Yes. So, let me on off 1 second. Thank you, guys. Yeah. Come on. Mind is superb. The beauty of the mind is everything is here. That will be alert. But then physical lethargy will be there, right? Anyway, guys, come on. So, AMT credit, what is it? Provisions of section 115 JC dealing with alternate minimum tax shall apply in respect of all SSEs other than company. So, AMT shall apply to individuals, firms, LLP, BOI, all these things. Alternate minimum tax means the amount of tax computed on adjusted total income at the rate of 18.5% or 9% as the case may be. For every assessment year, 2 parallel computations are required. One is under normal tax, one more under AMT. And I have to do what? Whichever is higher. Applications of AMT to certain persons. So as I told you, The provisions related to AMT shall apply to any person who has claimed any deduction under ATIA to section RRB except ATP, 10AA and 35 AD. So provision related to AMT shall apply to any person who has claimed any deduction under ATIA to ATRRB, 10AA, 35 AD. Provisions of AMT shall not apply, as I told you guys, individual, HUF, AOP, BOI, artificial juridical person. Mind you here, very interesting to know, partnership firm, LLP, no exemption. Here if you see, AMT will apply to all. But here they are telling, if the adjusted total income does not exceed 20 lakhs, AMT shall not apply. So if there is a MCQ question, they'll ask, a partnership firm, their total income, adjusted total income is just 20 lakhs. Will AMT apply? 100% yes. 19 lakhs, will AMT apply? Yes. Individuals or HF, if such person opts for alternate tax regime under 115 BAC. Cooperative society under BAD. So compute this. Step number 1, compute as per normal tax provision. Step number 2, deductions under this one, depreciation, same, 18.5%, no change. In case a person other than a company being a unit located in an international financial services center which derives its income a convertible foreign exchange, the alternate minimum tax shall be 9%. So if you are a foreigner investing in a unit located in IFSC, then how much guys? 9% instead of 18.5%. The person who is liable to AMT shall furnish along with the return of income report from the chartered accountant certifying that the adjusted total income and AMT are in order. All other provisions will apply guys, no change, no certain change like that. Tax credit, AMT, tax credit. The AMT to the extent it exceeds tax as per normal provisions are available to the credit and can be set off within a period of 15 assessment years. Similar to that here. If AMT is greater than normal income tax, excess is AMT credit. Credit can be set off in the year in which tax as per normal provisions is more than the AMT. Credit set off cannot exceed the difference between normal income tax and AMT. Brought forward AMT shall be allowed to set off in a previous year even if, this is one interesting thing. What had happened was, this was inserted by Arun Jaitley. Because guys, for example, let's say you are an individual, okay? So you have claimed ATIA for assessment year 2021. That is your last year of claiming. AMT is 10 lakhs. Regular tax is 1 lakh. So 9 lakh is what? 9 lakh is your tax that you have to pay under AMT. No problem. You will pay 9 lakhs extra. Apart from that 1 lakh, 9 lakh extra. That is a credit now you are getting. Next year, what happens is ATIA gets exhausted. Can I do this credit? Can I have this credit? Ideally, no, because it says that the wordings of the section are such that AMT credit will not apply if you what do you say? See, what is the applicability of AMT? Only if he has claimed any deduction. The next year, as I told you, have you claimed any deduction? No, it got exhausted. Got exhausted. Have not claimed any income. What to do then? Problem. Correct? Problem. On the other hand, AMT will apply if does not apply if it is less than 20 lakh. Let's say this year mine was 40 lakh. So I have claimed AMT. Next year my adjusted total income is coming up to 10 lakh. So AMT will not apply. But can I carry forward the credit? Big problem was there. Litigation happened. Arun Jaitley inserted one dialogue. That dialogue is point number D. Brought forward AMT credit shall be allowed to be set off in any previous year even if the assessee has not claimed any deduction at NA 35 AD under chapter 6A and then adjusted total income does not exceed 20 lakh. Both the cases. So he inserted a line, 115 jade. Let me see, I'll show you that wordings. Nice wordings it is. IIT JE, no, this is 115 JE. See here, this was inserted by Arun Jaitley. 2014, when BJP came to power, one of the first things that they inserted was this. Notwithstanding anything contained in subsection 1, subsection 2. Subsection 1, 2 is talking about applicability of AMT. Credit for tax paid under JC shall be allowed in accordance with JD. It will be allowed as per this is JD. 1910, tax as per normal income tax provisions 5 lakhs. AMT 8 lakhs. A or B, whichever is higher, 8 lakhs. So what is the credit that I am getting? 3 lakhs. AMT credit, this is set off. Any set off? No. Actually paid 8. AMT credit balance 3 lakhs. 7 lakh, 9 lakh. I will pay 9 lakh. Extra 2 lakh credit. 3 plus 2, 5. 8 lakh 50, 5. I have to pay 8 lakh 50. But 3.5 lakh, can I claim credit? Yes. What is the balance? 5 minus 1.5, 3.5, 1.5. 7 and 5. How much I'll pay? 7. So 2 lakhs, can I, what do you say? 7 lakh I'm paying. So 2 lakhs, can I withdraw? Yeah, but then I don't have 2 lakhs. 1 lakh 50 I can withdraw here, set off. So remaining I have to pay 5 lakh plus extra 50,000, 5 lakh 50. Next year, 7 lakh and 8 lakh. So here I'll get 1 lakh extra credit. Next year, 6 lakh 50,000, AMT is nil. Still I can claim this 1 lakh, no problem. This was as per the Arun Jaitley's change that happened. Where the tax payable is increased or decreased as a result of an order, AMT also will be changed. This is just like MAT, SSE is not entitled to any interest or AMT credit. Where an SSE is entitled in a foreign tax credit under 90, 90 and 91, it is allowed against AMT, then FTC exceeds FTC admissible against tax payable. The normal provisions, the excess FTC can be ignored. Guys, same thing we have done in international taxation. So you can say refer international taxation lectures. That's about it. That's about AMT. Come to page P1, my dear friends. P1. Amalgamation. If you remember, we have done everything. So if a company, Brook Bond, amalgamates into Hindustan Liver, we have seen depreciation will be calculated and depreciation will be shared based on the number of days. At various junctures, we have already covered amalgamation and demerger and all that. Nothing to cover. Just quickly we have to revise, that's all. Then if you remember, any unamortized will be unamortized expense 35D will now shift to the, this is called amalgamating or TED company. What is this called? Amalgamating company. This is amalgamated company. So 35D unamortized value will go to the amalgamated company. Telecom license, ABB, if you remember, that will also go to the other company. Spectrum 35 ABA, that also will go. Expenses of amalgamation 35 DD, 1/5 will be transferred. Capex 3619, if you remember, family planning, that also will be transferred. Voluntary retirement scheme 35 DDA. Voluntary retirement scheme 35 DDA, that also 1/5 will go. All other AT, IB, IC, IE, that also will go to the other person. If there is any bad debt, we saw a case law, Veerabhadra Rao, C8. 9, 10, 11, 12. Bad debt, Veerabhadra Rao case. High Court told that the amalgamated company also will get the, what do you say? We can claim that expense. Bad debts recovered. 41.1. We saw it is taxable. The law was amended and taxable in the hands of the bad debts recovered. And 41.1 taxable in the hands of the amalgamated company. All that we have seen, guys. Same thing I have given here. And when the amount is sold, shares are distributed, capital gain is exempt. And only when you sell it, obviously, then it will come to you. Even if you are an individual, you get 5 shares in exchange of 4 shares in this company, whatever it is, that is exempt. At the time of your selling, then it will come. Cost of acquisition of the previous owner, or rather from you only, you are the previous owner, basically, whatever cost you are there in the previous company, let me say like that, then it will come. Always amalgamation, it should take the approval of what? High Court. So if you sort of try to do a merger without High Court approval by transferring all the assets of one company to the other assets to the other company, by distribution of property of one company to the other company, it will not be called as amalgamation as in this section, because you have not gone through the High Court route. According to 2(1)(b), amalgamation in relation to company means merger of one or more companies with another company, or merger of 2 or more companies to form a new company. Merger of one or more companies with another company. This is also, one or more companies with another company. Vodafone plus Idea. Or one company, Reliance taking over one more company, Tesseract. Merger by absorption. Or it could also mean 2 companies coming together to form a brand new company. The company or companies which so merge is called amalgamating, and the other company is called amalgamated. Merger will be treated as amalgamation only if the following occurs. These 3 conditions also we had discussed. Again we'll repeat, it's just a revision, already we have done. All the property of the amalgamating company should become the property of the amalgamated company. All the liabilities of the amalgamating company or company should become the liabilities of the amalgamated company. All property, all asset liability shifted. Now, third point, shareholders holding not less than 75% in value should become shareholders of the amalgamated company, because special resolution should be passed. But guys, Reliance wants to take over Tesseract. Reliance already has 20%. Now they're amalgamating. So basically, when they say shareholders of this company should be shareholders of this company, 75%. But the thing is, Reliance is already a shareholder. So should I take 75% of overall or 75% of the balance? Obviously 75% of balance, 80%. That's what it says. Doesn't make sense. You cannot allot shares to yourself. You are not Swami Nityananda. Me allotting shares to me through the company which is framed by me, not possible. So shareholder not holding not less than 75% in value, so the shares should become shareholders of the amalgamated company, other than those shares already held immediately before the amalgamation by the amalgamated company, its nominee, subsidiary, whatever. So we see here, A Limited is amalgamating with B Limited. B Limited holds 20% of shares in A Limited prior to amalgamation. For the purpose of above clause, the shareholders holding 75% or more of shares in value out of the 80% of the shares should become the shareholders of B Limited. Capital gain, as discussed already, guys, as per section 47, where shareholders are allotted with shares of the amalgamated company in exchange for shares of amalgamating company, does not amount to transfer. Hence, there is no capital gain. It will arise only when they are selling the shares. We have done this in depth in capital gains. Cost of acquisition of shares in the amalgamated company is the cost of acquisition in the amalgamating company. Period of holding will be from whatever it was there in the amalgamating company. Capital gains for the amalgamating company. There is no capital gains on transfer of capital asset by amalgamating company to amalgamated company. What is the capital gains for amalgamated company? All the assets become the property. Cost of acquisition is cost to previous owner. Period of holding includes the period of holding to previous owner. This is for the amalgamated company. This same thing I see. Expenses incurred for amalgamation shall be allowed over a period of 5 years in equal installments, 35DD. Reduction under 35 ABB, 35DE available on amalgamating company can be availed by the amalgamated company in the same manner as if the amalgamation had not taken place only. Same with 80IB. Kindly recall all these discussions. We had done everything there in the respective cases. But third point is not something that we have not done. We have just explained briefly but not done. Losses and unabsorbed depreciation of the amalgamating company shall be treated as that of the amalgamated company. The best part, why people go for amalgamation? 8th year, generally carry forward is allowed for 8 years. 8th year I amalgamate, the new company will get fresh period of 8 years. This is for loss. Unabsorbed depreciation can be carried forward indefinitely, as you know. As you know, it can be carried forward indefinitely. So if you come to set off and carry forward, page G6, we will finish it off here. This is for these companies. Fresh value for these companies. Accumulated loss and unabsorbed depreciation in amalgamating company is deemed to be the loss and unabsorbed depreciation in amalgamated company. Fresh 8 years. You will get fresh 8 years. Whereas unabsorbed depreciation unlimited only for these companies. First one, where there has been amalgamation of company owning an industrial undertaking or a ship or a hotel. Industrial undertaking or a ship or a hotel. So there were small undertakings who were doing business, but then the thing is they could not compete with Tatas, Birlas, Mafatlal, Singalias. So the bigger fish absorbed them, and they did it with one purpose. Once I amalgamate, their losses will come to me afresh. These are all industry demands, and government has, agreed to that industry demands. Similarly, many small shipping businesses are there which have been absorbed by these bigger shipping industries. Same thing. Hotels. Many hotels are there which will not run. So the thing is, a better management will come and take over some 5-star hotel. So all those hotels which were running under loss will now be profitable. But nevertheless, there was a hotel called Orange County, for example. Orange County was taken over by Evolve Back. If you see website of Evolve Back, you will know. Per day, it's some 50,000, 60,000 rupees per day. So it's like that. So a company owning an industrial undertaking or a ship or a hotel with another company, or a banking company with a specified bank, SBI or its subsidiary. So if you remember, all the, banking companies came under this. Banking company, it merged with one more specified bank. If you remember, Allahabad Bank, Bank of Baroda, your Syndicate Bank merged with Canara Bank, if you remember. All these things came under this. One or more PSUs with one or other more PSUs. So during that time, Air India, Indian Airlines used to be there. Indian Airlines merged with Air India under this. And not recently, it's been a few years ago, couple of years, Tata's took over Air India. Will that come under there? No. One PSU it is, but the Tata is not a PSU. For that, Finance Act 21 added this, guys. An erstwhile PSU, Air India, with one or more companies, if the share purchase agreement entered into under strategic disinvestment, this is the Narendra Modi's one more policy, strategic disinvestment. Restricted amalgamation of the said public sector company, and the amalgamation is carried out within 5 years from the end of the previous year in which restriction in the above share purchase agreement ends. So this is a classic example. This was inserted purely for what? Tata Air India. Tata said, bro, I will take over, but all your losses, you give me 8 more years. No, otherwise, why will I take over? So they changed the law for Ratan Tata. The shares of PSU are purchased by B if, as per the agreement of strategic disinvestment, companies cannot amalgamate till assessment year 31/3/2026. Losses and as on 31/3/2026 shall be the losses and unabsorbed depreciation once the amalgamation takes place. So here also in Tata there will be a share purchase agreement for a couple of years, and then things will go ahead. So this is all the share purchase agreements. There are certain conditions also, guys. Let us see those conditions. So there should be a sale of public sector company to a normal company. So here you can actually shares of Air India are purchased by, the PSU are purchased by Tata. So the share purchase agreement will say 2 years amalgamation will not take place. So when will the restriction end? 2 years later. So from that you should carry out the amalgamation within 5 years. That's the condition. And then all the provisions of amalgamation will apply. But you see, there are conditions to be satisfied by both. Only then it will apply. Otherwise, no. First one. What is the erstwhile public sector company? Means a company which was a public sector company in earlier years and ceases to be this because of strategic disinvestment. Air India, classic example. Strategic disinvestment means share of shareholding by the central or state government in a public sector company which results in reduction of its holding to below 51%. Same Air India. Accumulated loss and unabsorbed depreciation of the amalgamating company, which becomes loss of the amalgamated company, shall not be more than the accumulated loss of the public sector as on the date on which such company ceases to be a public sector undertaking. Shall not be more than the accumulated loss. Basically, let us say on 1/4/2021, this is the date when the disinvestment happened. The losses were 80,000 crore. Share purchase agreement said 2 years you cannot do anything. As on 31/3/2023, 2 years later, still amalgamation has not taken place. Losses are still there. Loss has become 1 lakh crore. Now tell me, guys, will you take 80,000 crore or 1 lakh crore is what they are asking. Accumulated loss and unabsorbed depreciation of the amalgamating company, Air India, which becomes loss of the amalgamating company, Tata, shall not be more than accumulated loss of the public sector company as on the date on which company ceases to be public sector company, 80,000. So you cannot use amalgamation as a tool to increase the losses and take over extra 20,000. So Tatas cannot make a scam whereby 2 years they'll not work only on Air India, thereby increasing the losses to 1 lakh crore, then takes over the company because the share purchase agreement ends, and then jingalala for them. What? 1 lakh crore. Continuous 8 years. Good provision. Good provision by Nirmala Madam. Yes, conditions to be satisfied by the amalgamating company. Amalgamating company should have been engaged in the business for 3 or more years. So basically it should not be a new company. Amalgamating company should hold at least 3/4 of the book value of fixed assets on the date of amalgamation as it did 2 years prior to the date of amalgamation. As it did 2 years prior to the date of amalgamation. 75% of the book value of assets they should hold. So, for example, book value as on 2018, book value as on 2021. Asset A, B, C, D, E, whether these are the book values 50 lakh, 40 lakh, 20 lakh, 30 lakh, 60 lakh. Here only B, C, D are there. So here how many? 100, 150, 200 lakhs. Here B 30, C 15, D 25, E 45. Let's say 115 lakhs. So does it mean that 75% of 200 should be there? 150 should be there. 150 is not matching to 115. Wrong. No. No. What does it say? Read again, guys. The amalgamating company should hold. Amalgamating company, that is the first one. Same, amalgamating company only should hold at least 3/4 of the book value of the fixed assets on the date of amalgamation. This is the date of amalgamation. As it did 2 years prior to the date of amalgamation. So 20, I'll make this 20. 2 years prior. What they are trying to tell? 3/4 of the book value of the fixed assets on the date of amalgamation as it did 2 years prior to the date of amalgamation. So, here what they are trying to tell, guys, this reduction in value is due to depreciation, right? Nothing else can happen apart from some sale here and there, that's okay. So you see, what they are trying to tell is the book value as on the date of amalgamation of the same assets which are there here, B, C, D, E, block, B, C, D, E. The book values of these assets, 1 for 100, 150, 150. The book value of the assets should represent 75% of the assets as on that day. 150 by 200 is 75%. That 75% of 200, 150 by 200 is already represented on 2018. Is it continuing here? Yes. That's all. This reduction in value obviously is because of depreciation and other things. The book value of the assets as on 2020 is of no relevance. That's the important point. The book value as on 2020 is not at all relevant. What is relevant is 2018. Those assets which were there 2 years ago, were they representing 75%? The answer is yes, then same thing will continue here. Got it? For instance, in this only D and D are remaining here. 90 by 200, was it representing 75%? No, not representing 75%. So if you see, amalgamating company should hold at least 3/4 of the book value of assets on the date of amalgamation as it did 2 years prior to the date of amalgamation. This is the date of amalgamation. Is it representing 3/4 of the assets? Yes, it is. In fact, if you see here, BCDE, full 100%, 115 it is, because A is not even there if you think about it. That is what you need to see. Got it, guys? Hope you understood this. I repeat, it is book value as on 2020 is of no relevance, because what has to be seen is what? Fixed assets which constitute 75% of the book value on the that is 2 years ago, should continue to remain. That should continue to remain. The asset should continue to remain because the reduction in value is due to what? Various things. But the book value should be compared as on the date of amalgamation. Nothing else is what they are trying to tell. Conditions to be satisfied by amalgamated company. Now, the amalgamated company should hold at least 3/4 of the book value of the fixed assets continuously. Earlier only assets were there. Then assets will include stock, etc. Dangerous. That's why they made it fixed assets. Who will keep stock for 5 years? Continuously for a period of 5 years from the date of amalgamation. Amalgamating company. Business of the amalgamating company should be continued by the amalgamated company for a minimum period of 5 years. Can't change the business. Amalgamated company fulfills additional conditions as prescribed in rule number C. Means what? Production of at least 50% of the installed capacity before the end of 4 years from the date of amalgamation. Continue to maintain the same 5 years from the date of amalgamation. Amalgamated company duly verified CA certificate. If any of the above conditions are not complied with the set of loss, etc., in any previous year in the hands of the amalgamated company, shall be deemed as the income of the amalgamated company. Whatever you loss you claim set off, that set off will not be allowed, it will be deemed to be income. And guys, it is only talking about business. Speculative loss of the amalgamating company cannot be carried forward and set off by the amalgamating company. This should be amalgamated company. Right. So if you see, guys, what does it say here? Industrial undertaking. What is industrial undertaking that they have defined here? See, manufacture or processing of goods, even software. People could not match up to Infosys, etc. They were eventually taken over by other companies. That's what it is. Generation and distribution of electricity. Telecom services. Remember, you had this Spice, Aircel, Orange, everything wiped out because bigger players came and amalgamated because of this only. They said, if you don't add telecom here, I will not take over. If you don't take over, then that's it, over. You will, I'll not get that benefit, right? Excuse me. Excuse me, guys. Whether basic or cellular. Earlier, we used to just sneeze like that. After COVID, after 2020, we have now understood that you have to sneeze like this. All those things. Yeah. Earlier, when we were coughing, sneezing, people were telling, bless you. Now, when we cough or sneeze, people will tell, bless me. Why? Because if I cough at you, you have to bless yourself. Otherwise, all that, Corona, COVID. Right. Sir, we are sitting and just seeing your stupid face. We are not face to face, thank God. Right? Whether basic or cellular, including radio paging, domestic satellite, all these things, guys. Mining, ships, aircraft, railway systems, all these things are there. Railway system, anyway, now privatization is what they are planning, government, but IRCTC is the dominant monopoly. That's about this amalgamation, guys. As far as amalgamation of foreign company is concerned, transfer of shares in an Indian company in a scheme of amalgamation by amalgamating company, it's exempt, subject to following. At least 25% of the shareholders of the amalgamating foreign company shall continue here. Special resolution thing because of that. Such transfer does not attract capital gains in the country in which the amalgamating company is incorporated. This you have also seen in international taxation. Yes, transfer of shares in a country which derive its value directly or indirectly in Indian company scheme of amalgamation. This was our classic example of, Vodafone. If you remember, in international taxation, we did this. So that is about amalgamation. So just write down here the losses of amalgamating company under first one, capital gain, second one, house property, third one, owning and maintaining race horses. Fourth one, speculative business. Here no speculative business we saw, there only you can add off. Not here, sorry, in the set of speculation loss. Not just that, capital gain, house property, owning and maintaining racehorses. Because guys, only they speak about PGBP or nothing else. So those things will not come into the picture. So come to this in the set of carry forward. See, set of carry forward, we have done this part because it was linked to amalgamation. Then we are doing 72A4, we'll do it after demerger. Here, 72AA. Amalgamation in the case of one or more banking company with one or more banking institution under a scheme sanctioned by central government. So example guys, Global Trust Bank amalgamated or was taken over by Oriental Bank of Commerce because there was a scam by the promoters so many years ago. Yes, in that case tell me, shareholders of the old company, promoters only did scam, they will be shareholders of this Oriental Bank of Commerce? No. That's why special section, those provisions will not apply, no problem. One or more new corresponding bank with another bank. This is nationalized bank. PNB, actually OBC also was taken over by PNB. PNB took over OBC. Indian Bank took over Allahabad Bank. Canara Bank took over Syndicate Bank. Union Bank of India took over Corporation Bank and Andhra Bank. All these are examples of that. All that came under 72AA. One or more government company with another government company. Government company is taking over. Loss and unobserved depreciation shall be deemed to be the loss of amalgamated company for the previous year in which the scheme was brought into force. These are special provisions. None of the other conditions need to be fulfilled for this. No problem. Even if you don't fulfill the conditions, it is absolutely okay, is what this section says. Next, demerger. Guys, for example, demerger. Why do people go for demerger? It is for better economies of scale. So ABB, as I told you, they demerged into ABB Power. Siemens was one company into, this electronics, etc. Siemens Electronics. They had a telecom business also, which was incurring a loss. So if a profitable business and loss business comes together, then obviously the loss may overshadow the profit, right? That's why they enter into something called as, what do you say, demerger, whereby they will demerge. It could be a profit-making entity also, but for better economies of scale and better control, they will demerge. So for instance, if you see Reliance Jio Infocom, they demerged into two. Through a slum sale, they went into this Jio Infratel Private Limited. This is one company where this is only about towers. And one more company was Jio Digital Fiber Private Limited, resulting company. Demerged company was Reliance Jio Infocom. So predominantly, it got divided into three companies. One is Reliance Jio Infocom was the demerged company. Then two companies, Jio Digital Fiber Private Limited, only concentrating on fibers. Then of course your tower infrastructure company, Reliance Jio Infratel Private Limited. So demerger is a strategic reconstruction, strategic decision, so to speak, in the larger scheme of things. So coming to our thing now, page P2. demerger. So as per 219AA, demerger means transfer of an undertaking. An undertaking can be a branch, can be a unit inside that, by the demerged company to the resultant company. Same guys, all property transferred at book value should be the other companies, should be transferred at that rate. Revaluation from the beginning, revaluation should be ignored. Revaluation will not be taken into account. All liabilities also will be transferred. The properties and liabilities transferred shall be transferred at book values appearing in the books of accounts immediately before merger. So if the resulting company records at different value, the same shall be considered as Ind AS. Ind AS, whatever we did, the similar provisions will apply. So that is what they are trying to tell. The resultant company issues its shares on a proportionate basis to the shareholders of the demerged company, except where it is same thing. So I will issue for every 3 shares, I will issue 2 shares. But if I only held shares in you, that will be ignored. Then see, same thing. This is copy pasted from merger. Shareholders holding not less than 75% of shares in value agree to become the shareholders of the resultant company. Transfer of undertaking is on a going concern. In this regard, transfer of capital asset in a demerged company, the resulting company is not regarded as a transfer. So if my company, transfers some assets to your company, in this example, when both the companies shall issue equity shares to Reliance Jio Infocom, and I will demerge into this, and I am issuing shares here, it is not a transfer, is what they are saying. Transfer of capital asset in a demerger by the demerged company to the resulting company is not regarded as transfer. The resulting company is an Indian company. Similarly, transfer of shares by the resulting company. In this example here, this is the resulting company. Transfer of shares here. Transfer of a capital asset. All the assets were transferred here. This is not a transfer. Similarly, this is not a transfer. Jio Digital Fiber Private Limited issuing shares to Reliance Jio Infocom is not a transfer. Practically, I am teaching you. So capital gains also same thing. There will be no capital gain in the hands of the shareholder, the demerged company, when they receive shares of a resulting company. Period of holding, same, includes the period which the asset was held as a demerged company, same, no change. Cost of acquisition will be the same as before, but of course, here cost of acquisition, what will I do? I will take the net book value. Net book value of the assets in a demerger divided by net worth of the demerged company immediately before demerger into cost of acquisition in the demerged company. Cost of acquisition in the demerged company will be the original shares minus whatever was obtained above. Capital gains will be for the resulting company will be the same thing. Cost of acquisition will be the cost of acquisition of the assets in the demerged company. We have seen everything in capital gains already. Nevertheless, check the example here. Mr. Naveen is a shareholder in D Limited holding 1000 shares which were acquired for a consideration of 12 lakhs. D Limited transfers the assets and liabilities of one of its undertakings to R Limited. In consequence of such a demerger, Naveen is issued certain shares of R Limited in lieu of certain shares held in D Limited. You are informed that the book value of the assets transferred is rupees 175 lakhs. Book value of liabilities is 75 lakhs. Paid up share capital is 400 lakhs and general reserve is 100 lakhs as appearing in the books. To calculate what is the cost of acquisition of original shares held in D Limited, 12 lakhs. Net book value of assets which have been transferred, that is 175 minus liability. Net asset will be 100 lakhs. Net worth of D immediately before demerger. What is the total value? 400 plus 100, 500. So basically 100 out of 500 is what is transferred. 1/5, 20% is transferred is what they are saying. Cost of acquisition will be what, guys? This 12 lakhs is for the full company. What is the part which is demerged? 100 out of 500, no, 20%. So 20% of 12 lakhs, that is 2.4 lakhs is the cost of acquisition in R Limited. The cost of acquisition in D Limited will be the reverse, 12 lakhs minus 2.4%, basically 80%, that is 9.6. Hence, cost of acquisition in the resulting company is 2.4 lakh and the other one it is 9.6 lakh. Overall making it 12 lakh. That's all. And all these points are copy pasted from amalgamation, no change. This also no change, this also no change. Here instead of 25%, 75% value shares. That's it. And if you go to this set off and carry forward, Same copy paste. Where loss is directly relatable to the undertaking transferred, fully allocated to the resulting company, it is not directly relatable, apportioned between the ratio of assets retained and transferred. So in this example, if something related only to geo fiber related stuff, full loss will be allocated there. Otherwise, they will share between the as per the assets. That's it. Speculation loss cannot be carried forward. As far as the depreciation is concerned, if you remember, page B19. We had seen this that time. Again, we'll do explanation 7A to 43.1. Explanation 7A to 43.1. And if you remember, guys, distribution of assets to people, generally there is deemed dividend under 222, but we have seen for demerger, it is not a deemed dividend. All that we had discussed, guys, just a revision. But here, explanation 7A to 43.1. Asset transferred by a demerged company to resulting company, actual cost to resulting company is the WDV of the demerged company. WDV of the demerged company. So in pursuance of a scheme of demerger, B Limited was the resulting company. AB Limited. So if you see in the case of a demerged company, WDV of the block of assets in the immediately preceding year shall be reduced by the written down value of the assets transferred to the resulting company. Pursuant to a scheme of demerger, B Limited was the resulting company. AB, the demerged company, transferred an asset, only asset in the block whose opening WDV was 10 lakhs. Demerger took place on 1/8/2008 and the rate of depreciation of 15%. In case total depreciation for the entire year will be 10 lakhs into 15%, 1,50,000. Now this has to be, what do you say, distributed between the two companies on the ratio of the days. It happened on 1/8/2022, right? So the demerged company, it will be from 1/4/22 to 31/7/22, this depreciation. It is in this rate, and for the resulting company, this rate. Actual cost of the resulting company is what? WDV of the demerged company. So what is that given here? Total depreciation is 10 lakhs. The entire 10 lakhs, the only asset in the block is transferred. So for them, it is 10 lakhs minus whatever was held by the demerged company. So for the resulting company, actual cost will be 9,49,863. This we had also discussed during PGBP. We are just revising. That's about it, my dear friends, with respect to demerger. Then we'll see if there's anything else has to be done. We will see it in the next class. So in my opinion, 2 to 3 classes, that's it. Small classes of like 1 hour each, 1.5 hours each, as usual. We'll finish it off. Only miscellaneous provisions are left here. Everything else we have covered in depth. So these things just go through like this and go. Solve the previous year's question in the compiler. And if possible, I will also record 10-15 hours of Q&A solving and include it here, or I'll put it up on YouTube. Okay. I will try my best. Okay, guys, keep solving, buddies. So income tax, DT and international tax are quite easy. Just need to keep revising. Okay. Cheers.